I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Today's podcast is all about catching up with a business that was last on the show 5 years ago. And we've got an awful lot of catching up to do. Back then, Carbon Underwriting was on the show because it was one of the first crop of syndicates in a box at Lloyd's, laying out interesting ideas on how to modernise and optimise the underwriting of delegated authority business. Now it has matured into a carrier with GWP in the hundreds of millions that has built its own proprietary core systems and developed a broad and diverse capital ecosystem to support its underwriting. The last 5 years have also been transformative for the delegated underwriting sector, with explosive growth combining with strong results. That's why this interview with Carbon CEO Jacqui Ferrier is so interesting. As the market turns and a potential reckoning may lie in wait for the unwary or unprepared, Jacqui is a rare domain expert with her feet firmly on the ground and her eyes fixed on detailed underwriting data. The secrets of outperformance in delegated underwriting are all discussed here in the open for anyone who cares to listen. Fast ingestion of data, swift analysis and feedback, as well as absolute transparency with all stakeholders are key features. Jacqui can afford to be so open and candid about what constitutes Carbon's edge, in part, I think, because what she and her team have managed to build is the sort of thing that is easy to talk about, in theory, but extremely hard to execute in practice. So listen on. Jacqui is great company, and there is a huge amount of underwriting experience and expertise packed into the next 45 minutes. What's more, the possible future strategic directions for Carbon as it continues to scale are also a revelation. Enjoy the podcast. Jacqui, welcome to the Voice of Insurance.
Good morning, Mark. Lovely to be here.
For anybody who's listening out there who doesn't know you, I find that hard to believe, Jacqui, but for them, why don't you introduce yourself to them and run us a bit through your insurance career to date and tell us how you got where you are now?
Okay, quick intro. As perhaps the headlines say, I am one of the founders and CEO of Carbon Underwriting, but those nearest and dearest to me would perhaps describe me as a kid from Australia, from the bush, who loves to learn and loves to live.
What happened to your accent?
Good question. I think it's perhaps 15 years of living and loving my time in the Lloyd's market, perhaps maybe hanging around with too many of the elite English gentlemen.
London has just taken it out of you, but you haven't got a London accent, obviously. You've got to have the excellent received English pronunciation.
One must try. I think it was actually off the back of not being understood by my English peers and having to pronunciate one's vowels.
No, it's excellent. It's an improved version of English.
Oh, stop it. Stop it.
Yes, well, I'm listening back to this. I'll see if I can get any of that Australian accent out of you.
It'll probably take me a pint or two to speak a little bit more Australian. But my background, how did I enter this wonderful industry, insurance, reinsurance, and the Lloyd's market? Unlike my London peers, I didn't have the uncle or the family or friend connection into the Lloyd's market. It was actually rather a need to save my pennies in order to complete my master's in chiropractic science. The door opened, the universe spoke, and I was offered a short-term role at Swiss Re Asia Pacific as an administration assistant.
I don't know about you, but obviously I'm of a certain age where obviously like every man over 50 has a bad back. So we've got a nice big table here. So you're going to start sort of cracking bones.
Can you imagine? I mean, it's almost been 30 years now in this wonderful industry, and to reflect on what could have been, yes, cracking backs as opposed to underwriting, running a business. Exactly. So yes, I entered Swiss Re back in the late 90s, and I was very fortunate to work amongst a great team and a great boss that saw my, I suppose, enthusiasm and passion to learn more. And subject to me getting all of my administration jobs done, filing, data entry, all the fun stuff, which meant actually working the odd weekend. We would make time during the week to actually spend time with the underwriters, and the rest is history.
So it was not a market-facing role?
Not a market-facing role. It was pretty much the bottom of the bottom, and through a bit of hard work and a bit of stubbornness, just worked with great people who gave me the time.
So when did you start underwriting?
So early noughties. So it was 2000. I remember the year 2000, the Y2K exclusions.
I remember them.
But again, I was very fortunate to get a great introduction to pretty much all lines of insurance, so motor, accident and health, professional liability, D&O, recall, casualty, property, etc. So it was a really great nursery into understanding more about most of the insurance lines. Cutting your teeth in the Australian market, which is well known for its hard markets and its very soft markets.
That also, of course, at that time, the Aussie market had come out of a sort of spicy period.
This was almost a nice way of putting it, Mark.
There wasn't proper prudential regulator before, and then there was an after, where APRA is a formidable prudential regulator these days, and obviously has had an excellent track record since. But you have to have crisis before you bring it in.
Yeah, well, I think it was HIH collapse in, 2003? That absolutely was our largest corporate collapse in the history of Australian business. So it was about $5.5 billion collapse, and they had a market share of about 70% of the casualty market, which basically meant when we were working, living, breathing in Australian society stopped. Doctors put tools down, festivals stopped. It was just unreal. I'd never seen anything like it.
Yes, no, absolutely amazing. I mean, there wasn't probably anybody in the casualty world who didn't do something with HIH at that time. And obviously, they were quite a big player in the London market as well.
Yeah, the largest market share, absolutely. Yeah. So yes, it was a time of entering the market with the depths of the soft market and a lot of silly behaviour. And again, sitting in a reinsurer, I had a really great view of what was going on across the market. And then overnight, just seeing this wall of business that hit reinsurance at the time with the contraction of capacity at that insurance level. It was a learning curve so steep, and actually reflecting on probably the most fun 5 years of my career.
And so you were at Swiss Re until when?
So I was at Swiss Re for about 6 years, Mark, and then I was approached by AIG to actually help set up their primary risk-managed global accounts section. So that was fantastic. Again, quite unusual for a reinsurer to decide to move down the ladder into the retail world. But again, my curiosity and great need to learn, I wanted to learn more about what was happening at the ground level.
It's less abstract. There's more real people and real risks.
Yeah, real people. And other than just rate online type considerations within treaty or facultative world of reinsurance, was actually understanding the importance of a policy wording, importance of a retail broker, importance of risk management at that ground level. Actually knowing what an insured looked like. So yes, it was kicking tires. It was really getting a feel for the insured, the policyholder side, that even sitting here in the wholesale world still is very much what it is all about. It is about a fair price and the best product that we can give to our policyholders.
And then bring us up to date.
Bring us up to date. Right, the carbon journey.
How did you jump from AIG to carbon?
Yes.
The moves in between.
Well, how did I end up in Lloyd's wholesale world? Whilst at AIG, I was tapped on the shoulder by Stephen Catlin and Paul Brand and Doug Howard and Andrew Case to help set up their retail branch offering, which was fascinating. Lloyd's of London tapping a 29-year-old to allow the opportunity to build effectively a Lloyd's branch and have fantastic connections and direction from an executive team that I still to this very day have a huge amount of respect for. So as a 29-year-old in 2005, I built out the Catlin Australia branch for Stephen.
And so, yeah, that was your connection. Then when did you come over here?
When I came over here to the sunny shores of England, I transferred over in 2010. And the opportunity there was pretty much to help build out the international platform, along with Andrew McMillan, who's still a good friend of mine. He's doing very well over at Markel. Hello, Andrew. And whilst I was working at the box, I spent a lot of time on planes, traveling around the world, just getting a good grasp for the international marketplace. So
carbon, how does it come about? I can see, yes, with the Catlin XL and all the other things, presumably it was a great catalyst for lots of things to happen. It might have been the beginning of that something happening for you. I suppose it often is the case that, M&A fires the starting pistol for lots of people's careers and thinking, well, yeah, now I've got a reason to go and do something different.
Yeah. Look, I think it really stemmed off the back of sitting at the box in 2017 with my co-founder, Nick Tye. And whilst at the box, we wrote a mix of open market and MGA business, delegated business. And we foresaw effectively that whilst we're in the depths of the soft market, we saw the hard market on our doorstep. And we anticipated that the MGA sector would be under increased review, let's say. Of which it was. I mean, Lloyd's at the time had recognised that the majority of the growth of Lloyd's from a new business standpoint had actually stemmed from MGA business. And I think it was 40%, and I think it remains around 40% of the actual Lloyd's marketplace is MGA business. Lloyd's came knocking at our door at Catlin, and they were conducting a deep dive review, a bit like I think what's about to happen now under Rachel Turk's oversight. And they asked us to basically run through how we underwrite MGA business, how do we monitor the business, etc., asking all the right questions back in 2017. Fortunately, we did have a process which was very manual, let's put it that way, and it was a bunch of Excel spreadsheets. But again, we did have a plan and a process. Now, after that review, we were informed that we were actually the gold ticket. We were like the absolute best of the best. And that was when Nick and I looked at one another and thought, this is the best. This is the best. This is deeply concerning. And with that, it was a penny drop moment. And thought, hey, there's an opportunity here to do this better. And that's really that golden ticket moment of, yeah, let's do something really crazy and not go to VC or PE with an idea. Let's not be burdened by doing things too quickly, by writing a lot of premium in order to cover costs and pressure of hitting multiples in 3 to 5 year periods. So we decided to remortgage our homes and actually go out on our own. And that's what we did. So there was 3 of us, Ben Laidlaw, Nick Ty, and myself. And of course, we thought, hang on, 3 underwriters, we might need some help on how do we build a business? And that's where we approached Stephen Card, Charles Taylor Insurance Services, to help build out our business platform.
Stephen was on the show representing Carbon during the pandemic. That's 5 years ago and a bit. Fill us in on what's happened since. Bring us up to date.
Yeah, well, it's lovely, actually. I actually read the transcript of your podcast with Stephen, and everything that he set out that we were looking to achieve over the next 5 years has happened, which is really great. So when you look at potentially a 4-man band, we now have 78 people in the business. We were a syndicate in the box at the time. We just become awarded their great honour. And we had ambitions of becoming a full-fledged syndicate. That did happen in 2023. And we now write just under $500 million of gross written premium. We have stuck to our knitting, our niche, our focus, which is what we said we would do. And we have done that. And we have focused solely on the MGA sector because we have built a business to deal only with the MGA sector. A lot of the planning around how we were going to build a business and what were the USP specific to dealing head on with those issues of MGA businesses was the problem of data. And often on your podcast, you have a lot of focus on AI and data. And we were all aware 5-7 years ago when we started the business, that data was a systemic problem across the whole industry. We chose to focus only on the MGA sector. We thought that was the first, with the headwinds of the hard market coming, that would be the area that we could make a difference. So, of course, that's where we built our graphene platform. So again, when Stephen spoke to you 5 years ago, that was still very much in POC spreadsheets and Power BI.
Proof of concept.
Proof of concept, yes. Apologies. We love an acronym.
Especially if it's got 3 letters.
Exactly right. So from spreadsheets to Power BI to building out a tech team where we focused on bringing in new talent into our industry. So we hired a fellow called Mark Oldroyd, who's still with us. He's our CTO from JP Morgan. Mark built hedge funds, algorithms, and trading platforms that works on 1,000th of a second. We brought him in, and Mark's done a fantastic job of building out the graphene team. So we have delivered on building an ecosystem, which we've called graphene, which enables us to ingest a significant amount of data automatically. So this is without human touch. So if you look at, again, from metrics outside of just premium and people, when you look at the data that's flowed through our system, we've had significant amount of scale and efficient scale that we've achieved. So let me give you some numbers. So when we started running MGA's business back in 2020, 2021, we had about 250 bordereaux that we would receive a month. We've now got over 2,500. So that's 30,000 bordereaux being ingested automatically, cleansed, standardized, data laid, and then pulled out into those underwriting insights that we need to really evidence what's in the book and what's making money in the portfolio. The fact we've been able to do that with keeping the graphene team lean is exactly what we said we would deliver on. We always talk about operational efficiency. We've got the numbers to prove, yes, operational efficiency.
Yes, every time you've got a new account, you didn't have to hire a new person, no?
Absolutely not. I mean, when you look at the early years of, again, our FTEs, we pretty much had a 50-50 kind of graphene underwriting management split. And today, graphene team represents about 20% of our FTE. So again, when you look at the metrics per FTE, again, it can evidence that we have some operational...
Full-time employee, I think.
Full-time employee. Oh, I've done it again.
Full-time employee for anyone who doesn't know that. So that perception when there's a broker walking up and down Lime Street and I ask them, oh, what's carbon all about? You'd want them to say something, well, they're really good. They are the delegated authority specialists. And if I give them the data, they can ingest it. They can tell me pretty quickly whether they want to support that. So would you like to be known as almost this sort of a standard in the way that Lloyd said back in the day that you were the gold standard of MGAs? And he said, oh, goodness me, we can do better than that. How do you want to be perceived? Do you want to be perceived as, wow, if we can get carbon capacity, that proves that we are very good at what we do. We go around saying we're really good at what we do to everybody, of course. But actually, what's better than having a carbon validating that, because we know that they're pretty good at doing that? Is that what you want to be perceived as?
I mean, bang on. Thank you, Mark. That's exactly. When you look at our mission statement, and again, back in 2017, 2018 time, we wanted to reset and transform the MGA sector as to how we traded within that space. We wanted to be seen as the go-to lead, the blue chip. Absolutely. Now, the question is, have we delivered on that? And I would say, perhaps somewhat biased, yes, we have. And the fact you've mentioned that Lloyd sees us potentially as the gold standard to MGA underwriting, goal achieved. Now, we don't spend too much time thinking about people's opinions of us. We are very much about delivering on our promises and delivering what we set out to achieve. And I think, yes, we have done that. I think if we were to think about how people would describe us, I would like to think, and I have heard this obviously from our supporters and from the market wide, that we are seen as entrepreneurial. Entrepreneurial means to us that we are here to identify problems and find solutions quickly. We are described as being agile to make decisions quickly, not through committees, but again, through hiring great talent, to empowering great talent is exactly what we need to keep. And lastly, I think it is around trust. We talk about this great industry being a people business, and it is about over time, and time matters in our market. It is about making sure that we do deliver on what we say we will deliver upon. Now, graphene allows us the ability to be very transparent around everything that we write and everything that's performing or not performing. And it's not a dashboard that we only keep to ourselves. This is actually a platform that we share with all of our clients and our stakeholders. So this is a system that we share our insights, near live insights. So there's no surprises. So trust is, over the period of 5 to 7 years, is obviously a product of that.
So you've got a delegated authority partner, you've spotted something in their book, something that's changing or something that's either good or not good. And you can say, well, have you noticed these are really good nuggets over here? Can you find more of them? Or actually, let's have a conversation about this. We think there's a problem here. Have you noticed as well that look at these ones? They all seem to have some characteristics that are problematic. And then, of course, you can have the same look through to your capital providers. I presume that they can also see all this stuff that's going on and they can interrogate it, and you can explain to them, we've spotted this problem, we're doing something about it already. Is that the idea? So it looks from the capital all the way through to the underwriting pen?
Absolutely. Again, our reinsurers, our capital, our managing agency, our cover holders all have access to graphene and their data set. Now, again, going back to that trust and being proactive as opposed to reactive, which is our industry's famous for, pulling the rug from under the table of particularly MGA businesses. Having too much capacity, then you don't have any capacity. It's almost shame on us as capacity to allow portfolios to get to a state where we are within 1 month of renewal deciding to non-renew or suggest that a 30% rate increase across the board is the way in which they'll continue to write that. So I think the cover holders, yes, they have a huge amount of trust and confidence that we are sharing their data back to them with our view of insights. And when we have our at minimum monthly catch-ups with them, this is not about opinions or so-and-so said this or gossip. This is actually real facts, real evidence. And it creates good, solid, constructive conversations as to how do we navigate through the market cycle, because essentially our USP has been built for the market cycles, and we spend most of our career mark in a soft market. So what I found frustrating as an underwriter is I didn't have the tools in which to really be able to hand on heart, factually defend what kind of rate increase, or it would be more of a gut instinct versus actually the truth, which is the data. What's the data telling us? Do we need to respond or otherwise?
That's really interesting. Often with portfolios, there's probably about 80% of it that's usually fine most of the time. It's always the other bit that's the problem that needs fixing, and they all get tarred with the same brush so often, don't they?
Yeah, and I think this goes back to volatility. I think fine if you're billions and billions and you can work on an aggregated basis of just keep almost outrunning the tail. But, when you are within that small to medium size, that's immensely volatile time. So again, it was part of the reason when we set the business up that we focused on building a portfolio that was focused on the SME sector. It was focused on low volatility. Again, we talk about risk profile, low, medium, high risk profile. We talk about how do we share our subscription syndicated model of Lloyd's amongst our peers in the market. How do we continue to reduce volatility? So it's by diversification across territory, by product line, by industry.
What's the composition of the portfolio today? And is that where you want it to be, by geography line?
Yeah. So it's all a bit boring. Boring is beautiful is a statement that is said regularly within the company. So again, when Stephen Carl sat with you 5 years ago, we had a property and casualty SME international focus. Today, we've moved from 2 lines of business to effectively got about 8 core lines of business, but we have 125 risk codes approved from Lloyd's. So again, we focus most on commercial lines of business because that's, again, when you think about our target sector of SMEs, they are the lines that are most meaningful to them. From a geography perspective, yes, we are international. I'd say core 10 countries is really where we operate. Over the course of, again, looking ahead, we are looking to, again, explore further outside of those core 10 countries. Majority is not US. Again, when we set out the syndicate in the box, we're focused on, the majority would be international. Yes, we do have the multi-line risk code, and we do have some US exposure in our syndicated platform. It's a nice quarter. You wouldn't make it up. But again, if we've got Canada, Australia, Europe, UK are our core territories, and it's a nice even split between them.
Is there anything that you won't do?
Good question. I've always believed that anything is possible at the right terms and right price, but I've also been very clear that we do not dabble in lines of business or territories we do not understand. Now, our model is about delegating. We delegate our pen to basically people that know more than we do, right? Why would you delegate? Or that they have a distribution that you cannot access. Now, we can access a lot of business in Lloyd's. A lot of that business historically has been quite heavy. So again, our focus has been on trying to bring a bit more balance to the Lloyd's portfolio. So we've spent a number of years exploring the various territories where we feel that either from a political or from a judicial point of view and a data standard point of view, that they are at a level of maturity. And that's why we're not operating in the 60 countries where we know Lloyd's has licenses to write on an insurance level, that we're focused really on those 10 territories. So we are very much about delegating our capacity to people that know more than us, but yet still we have to have some in-house expertise to make sure that, of course, they are doing that.
Would you expect to be expanding geographically? Obviously, there's Asia, there's South America, there are other continents available.
Yeah, so I think it all comes down to time and focus, okay? So I think, again, we have less than 2% of the MGA market share in Lloyd's. We say we are the MGA lead, but yet we have less than 2% market share. So we have a lot of scope, a bigger pond to fish in, and that's within the international space. Now, US is actually part of our offering currently. Perhaps maybe it's worth reminding you that we aren't just a Lloyd's syndicate, that we also operate off our consortium, and we have our MGA platform. So we are able to actually write US business, but not via our syndicated platform.
You've got a new submission, you've got somebody looking for capacity. What are you really looking for with them? Well, it sounds like you want them to have really, really good data so you can put it in the graphene machine. Otherwise, presume that's a bit of a non-starter if it's like, well, no, we haven't got it. Is that what you're really looking for? Are you looking for people with great track records already, or?
It is the right question to ask, and I get asked that question a lot, is from a partnership selection piece. And in my mind, I kind of split it in the quantitative and the qualitative buckets. Okay, quantitative is kind of where our graphene solution comes in, around really evidencing what's in the book, profitability, again, segmentation, etc. So again, we can pre-bind, ingest that information into our system to get a good color effectively of that portfolio and sort of see, again, that 80-20 rule that you mentioned. Actually, you look at most portfolios have effectively it's 20% of the premium that's driving 80% of your claim. So again, we can sort of sit there and talk with the cover holder around, do you want to continue to write that class of business, et cetera, et cetera. That's the quantitative piece. Now, again, it goes back to how much of the international markets we've penetrated. Again, our data standards historically been very high. They continue to be high. However, we've now got, 5.5 billion of premium in our graphene system. So we have quite a strong view around certain segments, et cetera. So we may be slightly more open to actually looking at partnerships that don't have the 7 to 10 years loss experience that we historically are used to. So you have the quantitative bucket, the whites of the eyes, the qualitative piece. Now, this is just as important. Again, we go back to the trust piece. Are we aligned? And we talk about alignment a lot with MGA, capacity backing MGAs. This is about having those honest conversations around what their ambition is over the next 3 to 5 years. How do they see our capacity MGA partnership working? I mean, I had a great conversation with a cover holder in Australia years ago. And again, at the time it was a soft market, too much capacity being thrown at them. I said, we've never had a capacity market actually have an honest conversation around the areas of the business that I need to improve on. And it sort of dawned on me that we don't really have a quality metric. We talk about numbers all the time, but it's like, well, what about the softer side of your business operation, almost management consulting like? So are they interested in bringing in their own claims capability? Are they interested in actually investing in their technology? Are they interested in actually understanding what their ultimate position on their portfolio is and what their projected profit commission is 3 years before the 3-year PC? Underwriters never talk about ultimate positions with our MGAs. I mean, this is a scary fact. So again, when you meet those MGAs that really want to improve their businesses, make their businesses better, they're very much at the top of our list around partnering with them. And there may be some of those partners that we have reviewed that actually their data maybe not so great, or even they've made some errors in the past, but actually they've got the right attitude and they're willing to invest in actually making their business better by hiring better talent, bringing in their claims, investing in tech, wanting to have those conversations with us as to how to grow. That's the partner we want to work with.
It's really interesting that whole AM Best now rating MGAs. The most sophisticated MGAs are saying, well, look, I'm a virtual insurance company. I just don't do the capital part of it. And now an agency that's traditionally rated companies that have the capital as well have obviously spent a lot of the time over the last 30 years getting into that softer side of things. It was originally things like ERM, wasn't it, back in the day? So yes, you can see that's the way things are going. You've been at an extraordinary time in delegated underwriting. There's been a great boom in MGAs. How do you view it? Do you think it's a permanent change in the way things are being done? Just because we can now, probably it's technology ultimately behind all of this, because you don't have to have the capital anymore. The capital can be provided to you because you can run a virtual insurance company and you can just isolate the bit that you're really good at, which is the underwriting, and say, well, I don't need to do the stuff that the CFO did, talking to the investors and all that kind of stuff. Other people can do that and they're really good at that. And I'm just good at the underwriting part. That's my theory around it, I suppose, that why wouldn't you just stick to the thing you're really good at? It makes tons of sense. Is that the way you see it? And do you think this is going to carry on? Is this boom going to go on? Not say forever, or until everybody's an MGA and the capital is just the capital.
Yeah, look, I think obviously a huge fan of the MGA model, being an MGA ourselves. There has been a boom and obviously a significant amount of investment, a lot of capital coming into the market to back a lot of startups of late. Look, I think it would be naive of us to think that with the change in the rating environment, we talk about a softening market, that it's not going to impact, obviously, the MGA delegated sector. Absolutely, it will. For us, it's our view that it will help sort the wheat from the chaff. We'll also bring home the realities. If you don't have a reason to exist, if you're not bringing something of value, your days are numbered. And again, there's, of course, been mention of some consolidation out there in the market, because there has been a lot of investment. The market timing may be slightly off. So yeah, look, I think we are lucky to perhaps in some ways have first mover advantage around building out a technology platform, which I must say, it takes time. Quality takes time, Mark, and building relationships, partnerships, as I said, trust takes time. I mean, we haven't lost any cover holders, any capacity, any capital, any reinsurance during our 7 years. We have a good, steady platform. So we are in a strong position. As I said, I think it's down to MGAs to demonstrate that there is value. And I think you look back 10, 15 years ago, there's been significant improvements in how MGAs are regulated, monitored. Capacity is a lot more demanding on MGAs to demonstrate their X factor, demonstrate that they've got their ship in order, let's say. So I think, yeah, the problems of MGAs back in the 90s, noughties, I don't think we will see that.
Yeah, not just a post box that moves things from one place to another and adds 10% commission anymore. It has to add a huge amount and add some understanding, well, a lot of understanding of that particular risk.
Absolutely. And I think, evidencing data, I mean, we've been talking about data for years now, and I think it's encouraging. Again, a lot of your podcast, Mark, is very much on AI and data. And I think, what is a luxury for an MGA that has started out in the last 5-10 years, like ourselves, is we had no legacy negative tech that we had to kind of try and deconstruct. We had a blank canvas, tapping into modular type ecosystem software that we can easily change here and there without any downflow complexity or massive investment required to unwind old systems. So I do think there is a place for MGAs and just some of the talents jumping from these billion balance sheet type insurance companies into start their own businesses.
Would you say that that's the optimal way for an entrepreneurial underwriter to go and do something? It's clearly an MGA because they don't have to do the capital side of things.
Yeah. I mean, I talked about that agility piece, being agile and being empowered, that bureaucracy and complexity of decision making can be a real frustration. Again, I have worked at the largest reinsurer and the largest insurer, and at the time, the largest Lloyd's syndicate. And there was a number of times that we had ideas, but again, not because these great firms didn't agree that they were great ideas, but to actually start to...
There's a lot of inertia, isn't there?
A lot of inertia. Yeah, it's a good word, Mark. So again, you have the freedom to be creative and innovative. And yes, there are multiple capacity capital platforms that you can tap into in order to ensure that you continue to have capacity for your client base.
About the human side of things, you mentioned, of course, you've got that operational efficiency built in with your platform. Mm-hmm. If you double in size, you don't have to double the headcount every time, which is great. So what are those people for? You mentioned before about these monthly touch points. It sounds like that's where the people spend their time. If they've got all the data at their fingertips, then it's the human side of it. It sounds like it's still really important, even if you're massively data heavy. It seems like being sort of people rich is also, does it then accentuate how important it is to have that relationship? You can have a better relationship if your technology is better.
Absolutely. I think it's machine and human working together. Again, at Carbon, we have built a system for underwriters because it didn't exist, Mark. So I think, yes, AI and, again, all the operational efficiency is there to, I suppose, remove the churn, which allows underwriters more time to make smarter data-led decisions around what to do with a portfolio. And that's kind of it. I mean, when you look at how we've used AI within our business, there's been huge benefits around, as I've already said, that ingestion of information. But more importantly, when we're ingesting data, a lot of the time the data is in free text. It's not numbers. So if you look at claims, this is crazy.
It's just hundreds of reports, isn't it? There's maybe a police report, a medical report, a legal report.
A lot of words, Mark, a lot of words. So how can you take words and make a number out of words? Again, a really exciting project. It's our codification, our carbon codification across type of risk and type of claim. This is pretty cool stuff, actually. So again, there's been a lot of debate around platform versus standardized codification across the industry. What's the answer? What's the solution? It's the right debate to be having, but what we've at Carbon with our graphene platform completed over the last number of years is actually we've created our own solution. We've almost, I like to think of it like a Google Translate. We have built a system, a machine, this is the AI bit, that is able to pick up all those free words, those free text in claims, for example, and pull them into our carbon claims codes. So when you think about what drives poor performance, underwriting performance, A lot of that is attritional loss ratios, attritional losses. It's not typically the large losses or the event losses. Now, as an industry, we do codify an event.
I mean, the largest ones, at least that's what you got the reinsurance for.
Exactly. But what are we doing with attritional losses? How do we actually know what's driving attrition in our portfolios? The industry doesn't, Mark. We do, because we codify our claims.
So what is it? Well, it's different for every risk, isn't it?
And that's exactly it.
And in different territories, obviously.
Exactly. So we know our top 10 drivers of attritional loss through our $500 million portfolio, out of our $5.5 billion of premium going through. We actually know which industries. It's a bit of a wow moment. Now, when we talk about cycle management, we understand what's driving attrition in our portfolio at a macro level and at a claim level. So again, which the risks that are driving those claims. Again, my active underwriter, Rob Crocker, he describes it. It's an open market view to a binder portfolio. So we understand at risk level what's driving and the claims level. So if you don't have those two, how can you manage your attritional losses and performance?
So when you're talking to those clients, it sounds like you've got a lot to talk about because you're helping them get to the nub of what is in their attrition in those high volume, small number claims. Then there's a lot to talk about, isn't there, I presume? So that's what you talk about every month.
Yeah, absolutely. Yeah. And again, it's our reinsurers that may support us on a quota share basis. It's our capital. Again, this is where that trust with how do we want to be perceived is they trust us. They've got the confidence that we can evidence, not just talk about what we think, but we can evidence what is going on. And it's actually something we're not just keeping to ourselves and what we're doing about it.
It's that sustainability. The reason why people want to come talk to you is because if the market suddenly changes, hopefully you'll know why it's changed and you'll be able to tell all your capacity providers what you're doing about it. And so hopefully you'd be still top of their list and say, well, we need to carry on supporting these people because they already have it. They're already on top of it. They were on top of it before I even phoned them about it.
Yeah, absolutely. And I think, going back to the machine and the human, I think we have accepted that underwriting is somewhat of an art. Underwriting is looking
Presumably
ahead.
The machine must get things completely wrong sometimes.
Well, exactly. No, I mean, the machine is good to kind of cleanse and remove churn and to summarize and sharpen what is in that data set. Now, it does that very well. What it can't do is it doesn't have the nuance or the accountability or the insights go forward, right? So that's where the underwriting comes in. I mean, we live in a very unpredictable world at the moment and we operate in the world of risk. So what graphene is there to help us and with the machine is together, let's look at the data really quickly. So it's not just about actually understanding what is in the book. We're getting that information in quicker than most of our peers in the market, which means any of those trends, like if you think about the impact of COVID, if you think about what's happening in the geopolitical space, if you think about what is the world going to look like in 5 years' time, there's no actuarial data that's going to tell us that. So absolutely vital to have the machine trying to help the underwriter pick up those trends quicker than our competitors. It's also there to, again, for those people on the ground to kind of help them identify what's happening in the courts, et cetera, et cetera. So it is very much there to help humans do a better job, basically.
Yes, I mean, COVID, I think, is the classic sort of derogation of duty. I mean, when I was the editor of a magazine, we had new reporters and they were sort of just starting to cover the results of companies. And, if I was asked to explain, so how do these things really work? And I said, well, in the nicest possible ways, a lot of insurance companies are like a big sort of slush fund that is sloshing around. And as long as there's enough, everyone's happy. And as long as it produces more cash than what it started with, generally people are happy. It's when the cash starts bubbling out at a rate, then people say, well, we probably need to do something about this. And as long as the cash flow is positive, it's fine. But the great derogation of duty, I'd say, and also as journalists, it becomes very difficult because you have an event and then the first quarter, we're all over it. The second quarter after that thing, we're watching all the results say that word. What does it say about Japan or what does it say about wildfires? And then the fifth quarter, it's just completely disappeared because it's already 1 year afterwards. It's washed through into this slosh. And the pandemic's done exactly that. It completely disappeared. We don't know what happened to it, really. And, as an investigative journalist, someone needs to sit down and say, well, what did it actually cost? And what did we think it was going to cost? What have we actually learned from it? I'm not sure. Well, I'm glad that someone's still sitting around trying to make sense of all this because everyone else has moved on. It's like, oh, well, it's too complicated. Let's move on. I mean, everything was okay. We traded through, which is the kind of insurance way of doing things. But it's probably not the best possible way of doing it, not in today's world where you've got AI and got ways of ingesting all that information and trying to really understand and trying to learn something from it.
Yeah, you're absolutely spot on. I think, when we talk about predictive analytics, looking forward, it's like, well, what have we learned and how have we captured that? We know in our Italian municipal book, we actually saw a deterioration of between 4 to 5% in our loss ratios because this is during COVID. The wild pigs.
Oh yeah, but they went wild. Coming to town.
There were so many wild pigs. I'm not kidding. That literally caused so many traffic accidents and damage to cars, and it literally caused.
It's been a problem, and it's a problem in Spain also. Well, also rats weren't eating the electrics of cars that were not being driven. They were just sitting around in garages and whatever, and rats were eating through the wires and stuff. You wrote about the wild boars in Spain. Obviously, Spain famous for wild boars. They were sort of in the outskirts of Barcelona, but actually started to cause swine flu, which is terrible, which could be a huge agricultural loss because suddenly the domesticated pigs were getting close to the wild pigs and they'd never been close before, and suddenly became a new problem. It's like, oh God, we never thought of this.
Exactly. And this is why, again, seasoned underwriters, they've seen a lot of attritional losses and large losses. And it's like, that's where the gut instinct kind of comes in. It's like, hang on now, I remember there was the problem with the wild pigs. Now, what we can do is, again, support those assumptions or gut instincts with some data and go, hey, there's another pandemic. Now, what's the council's going to be doing during that period of time? Oh, okay, there may be an improved risk management there.
Yes. When I was preparing the interview with you, looking at your website, something caught my eye was the Property and Whole Account Consortium.
Yes.
Whole account's one of those slightly scary words, back in the day. What's it all about?
Yeah, no, thanks for raising that. So back to the mission, the vision of actually being the go-to lead of delegated authority business within the Lloyd's marketplace. There was always the ambition to have our peers within the marketplace under the subscription model follow what we do, not just because we're good underwriters, but because actually they get the same data insights that we have. And we know we're pretty good at that because, again, we've focused on building graphene, building our partnership model, and sharing that with the wider market. Now, consortia, a bit like our reinsurance strategy, is whether it's reinsurance quota share versus a consortium, it's in some ways kind of the same thing, right? So the positive of the consortium model is obviously managing your gross line outside of, say, reinsurance, where it's obviously gross and net. So it's really, I think, bringing home and validating that our USP is special and that we have our Lloyd's blue chip peers that are following what we're doing. And they get the added benefit, as I've already touched on, of data that they can answer the questions from Lloyd's or their own internal management around what is in your MGA portfolio. Carbon's right.
So you're leveraging your own expertise and, obviously you get some fees on the back of that as well.
And good news is it's not just property, it's whole account, not just property. So we've actually, again, a bit like the crawl, walk, run of building out our business, slow and steady. We started with the property consortia that then, of course, evolved into a 10% whole account. And this year is now 32% whole account. So when you look at I mentioned our gross written premiums are just under $500 million. When you look at our stamp.
So it's the whole of your account?
The whole of our account, yes. So our stamp on the Lloyd's is $320 million and we have about $117 million.
That's really interesting. It's almost like
consortia.
The facilitization of the Lloyd's market. Say the top 10 brokers into Lloyd's have probably all got a facility of some description these days, or if not, they're probably working on one and it's coming within the next year or so, looking at between sort of 15 to 30% of their book. Again, so you're all doing the same sort of thing?
Yeah, we are. Yeah, and we do not support any broker facilities at this stage, but...
But at least you're in a position where you could ingest a mega broker's amount of information. If as long as your graphene machine doesn't break when it ingests that much information, it seems like you've built it so it could take anything.
Yeah, absolutely spot on. I think if we were to consider facilities, we would be best placed within the Lloyd's market to consider them because of course, our ability to ingest data in any format, whether it's a core standard, whether it's API. We had 31% of our data that's actually ingested via API, bordereau. Whether it's a broker portfolio, yes, we have the ability to ingest, cleanse, standardize.
We have a hat trick of 3-letter abbreviation undoings. And API I always forget. I just know what it is. I forget what it stands for. It's like programmer interface or something.
That will do. Yes, I think.
Anyway, it'll be in the notes because I always get it slightly wrong. But anyway, all it means is that sort of computer will speak under computer and the humans don't have to get involved.
It's been described to me as a bridge. So I thought that works for me.
I'm fully plugged into your thing. We don't have to talk about it. It's just there. It's already there. It's in my screen.
Again, it's all about, I'm going back to the interview I had with Mark Oldroyd, our CTO, so ex-banker, where I described to him just the data quality issues, but also the pace of data in our market being very slow. And he said, oh, what do you mean? Like, as in like a second? And I said, no. He said, not a day. I said, no. A week? No. Month? No. Bordereau. It can take up 3 months. So if you're sitting in the reinsurance world, between 6 to 9 months, Mark. That's 6 to 9 months before a reinsurer will get access to the information if it's been actually downloaded to a bordereau.
It's not good enough.
It's not good enough, which is, again, going back to that very reactive as to whether or not, again, we want to write this business. Oh, dear. The ship has sailed.
It's sort of the legendary story, wasn't it? The Hurricane Betsy. But there were certainly stories of syndicates. They hadn't realised their Betsy exposure and they had to reduce their capacity during the following year because they were only getting those notifications coming in a year late because they really didn't know what was being done on their behalf. And these things were coming in so late that they actually realised they didn't have the capacity that they thought they had at 1/1. And so, yes, I mean, we don't ever want to be in a situation where
no, we don't.
Happens.
I think, again, whilst our focus was very much on, MGA sector, I mean, if you take a step back and have a look at just insurance and reinsurance at whole, we have a major problem around codifying claims. So a lot of free text and delays of when the information is coming through. And I mean, even in our own findings, the bordereaux that do come through, 50% of them have errors. So if you're just downloading into a spreadsheet and pulling out Power BI, you've almost got one eye closed from what information's coming through.
Do you think we'll ever get rid of bordereau? Because if everything is an API, i.e. that everyone is plugged into everybody else and everyone is fully conscious of everybody else and sort of see and hear what everyone else can see and hear, you don't need to get together every quarter and add it all up. You can just do it yourself, can you?
Yeah, look, I think this comes back to standardization debate going on. Bordereau is just a standardized format in which, you enter information within that. So it is certainly a step outside of just a spreadsheet where you're just putting anything in there that's coming to capacity. So I think it's a step, but the question is, what's the next step? And so for us, rather than sit and wait, going back to the point I made earlier about where we're going to conclude, whether it's Blueprint 2, whether it's this ACOR, or whether it's like, let's just actually create a machine that can translate any data format. And if our cover holders quite savvy and sophisticated with their tech stack, which most aren't, there's certainly been improvements, we will API into them.
One other thing is, the launch of Syndicate 5757 was delayed. I think it was announced about over a year ago now. What was the rationale behind that, and is it going to happen?
Yeah, good question. So going back to the mission, again, global lead for our MGA business. The globe includes the US of A. Also, it was great to be accepted as one of the first syndicate in the box back in 2020. We were able to build a capital stack that actually loved their offering because it didn't include US. So again, we have a great capital stack under the 4747. This is the FAL support that we have that effectively likes the diversification credit around the US.
So right, so you needed another
we need to explore.
Of
and
capital.
Again, I am platform agnostic, right? Ultimately, as long as the security is good and there's an efficient way of trading and we have some good, sustainable, trustworthy blue chip confidence around our ability to every 12 months be able to support our MGAs all over the world, I'm platform agnostic. So we do have our MGA, which we are able to provide US product. So we are up and running a US business. For me and for the leadership team, for our ExCo, it's about scale. How big can that be? And so we're always looking at other options, whether it's an SPA, a syndicate, whether an MGA, the consortia model, in order to make sure that for those opportunities that come through, that we have enough scale capacity to support those.
Yes, you've got your own capital stack. What's your view on that? During your period of growth, we've had this parallel period of emergence of the hybrid carrier. Would you consider yourself as being part of that movement? Or what's your philosophy around it? It's always useful to have marshaled together some of your own capital.
Yeah. So I think when Stephen Card caught up with you 5 years ago, he did mention the corporate member. We have set up a personal corporate member so that the founders, key underwriters of the business have a corporate member. Okay, so we are personally aligned And again, I think it comes back to the debate or part of the underwriting of what is your alignment? And I would somewhat challenge the alignment of an MGA, an underwriter, an MGA that works on a 12-month basis, as in their livelihood depends on that 12-month contract renewing. In some cases, probably more alignment than another underwriter, perhaps that works for a billion plus balance sheet and what they choose to underwrite. So I think it's not using a blunt instrument and concluding that just because you don't have capacity balance sheet exposed that you don't care or you're not aligned. That's not the case, because in most cases, including ourselves, we actually have a hell of a lot on the line. Let's put it that. We are still a founder-led business, and we also have our corporate member, which is aligned. For me, it's going back to what is the best capacity capital solution for what type of risk, for what type of territory, and that can vary. Putting all your eggs in any one basket, we know, increases volatility. So we love the multiple platforms that we have access to through our MGA capacity markets, through our consortium. So again, a London subscriptions consortia. And then, of course, with our Syndicate 47, 20 markets on our VAL stack on our 47 platform.
Wow. So 57, we still expect to see it's still ongoing. It's not, you haven't sort of shelved it.
Yeah, so at the moment, our MGA consortia platform has a good amount of gross written premium attached to that. And yeah, we're always in discussion with our friends at Lloyd's, Dawn Miller, etc. They're very, very supportive of our ambitions to, when the timing is right, to actually look to potentially evolve that into an SPA or syndicate.
Right. Would it be your ambition to become your own managing agent?
Absolutely.
I don't know. You're sort of at that stage. What do you call it? Fledgling, or I don't know what we call it. We used to call it something like that. At that time, the sort of time when you've been through enough cycles and 3-year cycles to say, right, you might well have a go.
Absolutely, yeah. Look, I think it's you've got sort of horizon 1, 2, and 3.
Is it a cost thing ultimately? Because you need a whole board and kind of heavyweight things.
Yeah, we all know the benefits of having a managing agency, and yes, of course, fee when you start sort of tipping over into the billion gross written premiums over the next 2 to 3 years. Yes, that's quite a significant fee. Again, Astor, our relationship with Astor, Lorraine Hartford and Portugal have been absolutely outstanding, great supporters, and they've got
some
very
people
much
stay. Some people have just stayed forever, haven't they? So
yeah, I think for us, looking at our tech investment in the business as to our business model, graphene is not just a post-buying analytics tool, it's actually the digital spine of our business. And there's benefits of the efficiencies that we have, not just in allowing underwriters more time to make a better underwriting decision, but it impacts our finance, our operations, our compliance risk. Effectively, we can click a button to produce a report that probably would take some of our peers in the market months to create. Yeah. So there's huge amount of efficiencies. And yeah, a digitalized managing agency in the next 3 to 5 years, why not?
Graphene, by the way, obviously it's got a brand name. Would you ever put it in a box and sell it to someone? Yeah, I mean, these days, obviously you don't have CD-ROMs anymore. But you know what I mean? Would you sell it as a third-party piece of software to somebody to say, well, you want to run an insurance company, this is what you need? Or would you want to keep that as your proprietary sort of competitive advantage?
Yes, I think, again, another good question, Mark. This is not a bolt-on application. This is, as I've just touched on, it is the digital spine. But yes, there's certain components of graphene, like Graphene Studios, which is a no-code cleansing and standardization of data, which I have to say, having data in a centralized, like a lake, is actually one of the biggest hurdles that all insurers, brokers around the world face. So I think there has been some debate and we have been approached on a number of occasions to consider looking to lease out that studio component of our graphene system. Now, we sat there and thought, are we a tech company or are we an underwriting company? Is this a distraction? For now, we are not built to become a software company, but maybe in time, if the strategy is right, timing's right, it could be something that we look to share with the wider market. For now, we kind of share the benefit of graphene via the consortium model and our reinsurers, etc. As I said, oversubscribed on all fronts because they get access to a segment of MGA business, but they also get access to data that they cannot produce themselves.
One of the other things, obviously, is getting to this sort of level of maturity as a business. You've built this stable platform. You've got everything humming along. Your original investor, Apiary.
Yeah.
So that's beekeeping, isn't it? So are they looking to get their honey at some point? And then, and obviously when you get to a certain stage, I mean, it's normal to swap in new investors as you get to a different scale. It's a natural process. Are you closer to that being something on the agenda?
Well, you're absolutely spot on. I think, we all know the investment arc of private equity, and we are 3 years in with our friends at April. April have been fantastic. I think I touched on at the beginning of the podcast of pretty much a 4-man band, a bunch of underwriters trying to build a business. And I think what April have helped us build out, I would say, a proper senior leadership team with a proper CFO and COO and a board that's able to attract great talent. I really enjoyed working with, despite my initial concerns of working for PE. So, right now there is no deal, there is no process. Our focus is, of course, on continue to build on our business platform, to deliver on our promises. We don't build for an exit.
But also with you, obviously you are an entrepreneur, you've proven that, and you've done really, really well. Some people are sort of entrepreneurs who are quite restless, who like to solve problems, and then once they've solved them, they find other problems that are really compelling. They have to go and solve them. Are you one of those sort of people? Or there are other type who solve the problem, but actually they want to keep going with that almost forever, to say, well, carbon forever, and this is what I want to sort of hand down to my children, grandchildren type thing?
Look, I think the data problem and complexity still exists, very much exists. And I think for me, what's exciting is, a proof of concept works. I think we've got a really cool piece of kit that we can look to share with the world. The entrepreneurial, the ambition to continue to expand the business globally, to expand perhaps beyond just MGA business, but to the broader portfolio business, because that's what we underwrite here. We underwrite portfolio business. So I could see very much a nice, easy pivot, not distracting from our core, but a pivot into forms of, say, reinsurance. And we've touched on the US, I think, $100 billion market for MGA business. I mean, yes, there are a lot of gravestones in the US, we know that, but there are in Australia and other territories as well. So I think, I'm very excited about particularly the next 5 years. We have survived. We've delivered on what we said we would deliver on. As I touched on already, the transcript of Stephen Card's podcast 5 years ago and what we set out to achieve, we have achieved and more. Can we survive the next 5 years and continue to deliver on our promises? Is more than enough of a challenge.
So you've plenty to be getting on with, and you haven't found other new problems to solve. There's far too much potential in what you've already got.
Absolutely. Yeah.
Jacqui, thank you so much for your time. It's been really, really good.
Thank you, Mark.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.